Which dollar cost averaging strategy works best? We're going to compare different periods of buying. Buying every day, every week, every month, and once a year. We'll also compare dollar cost averaging with just buying once. To keep things simple, we'll only look at the S&P 500, specifically the SPDR S&P 500 ETF Trust, commonly known as SPY. For the time frame, we'll look back all the way to January 1994. We'll also just say you have $100,000 to start, and divide that equally among our dollar cost averaging strategies. First, let's look at buying every single day as a dollar cost averaging strategy. Over the course of 30 years, we see that buying every single trading day translates to $344,000 today. That's a 4.2% compounded annual growth rate. Next, let's look at buying once a week. Over that same period, once a week translates to $334,000 today. That's a 4.1% compounded annual growth rate. A little bit worse than buying every day. Third, let's look at buying once a month. Over that 30-year period, once a month translates to $346,000 today. That's a 4.2% compounded annual growth rate. It's about the same as buying daily. And fourth, let's look at buying once a year. Over that same period, once a year translates to $354,000 today. That's a 4.3% compounded annual growth rate. A little bit better than buying more frequently. After looking at these 4 DCA strategies, it's clear that the less often you utilize the strategy, the better your returns over the long term. Although, the difference between these 4 strategies is quite small. Finally, if we add the non-DCA strategy, we get a different result over the course of 30 years. Putting all $100,000 at the beginning will yield the best results. You'll have $941,000 today, translating into a 7.7% compounded annual growth rate. This is so much better than any DCA strategy. But here are 2 notes to piece from this short study. First, this assumes the past will be anything like the future. The past 30 years have been good for the stock market. That means if you just let everything ride out, you'll do fine. Second, for the average person, DCA is the most practical. With that being said, if you think the stock market will rise over the long term, and you have to use DCA, do it as less often as you possibly can. Invest wisely, and as always, take care of your money.